Very good morning, everyone. Thank you so much for joining us for this particular webinar. Just as a way of quick introduction, my name is IIT. I'm a partner at Zinnov Management Consulting Limited. We are a 20-year-old global strategy and management consulting firm, dual headquartered in US and India. Our core job is to help enterprises build, buy, and sell technology products and services. Majority of our customers are Fortune 500 clients. And core part of revenue comes from global markets, with India contributing to roughly about 10% of the revenue, APAC contributing to about 30% of the revenue. In terms of my own team, very specifically, I lead a team called as Conext within Zinnov. It's an innovation-focused practice which helps enterprises leverage startup collaboration, their employee base and academic partnerships to build new products, new services, and also to drive incremental innovation in terms of their business. Today, we work with companies across the world. And the interesting part of this is that while sitting in India, today we service 4 global markets in terms of North America, South America, Europe, and Asia. We also orchestrate partnerships between Indian startups with companies in these regions, but also bring in companies from North America, Europe into India, and rest of Asia into India to use India as a launch pad for future growth and a lot more sustainable global expansion, market share expansion for them. In terms of today's report, what we have on the table is a readout of an annual report that we do with NASSCOM. This report is focused very specifically on the technology startups in India, and it stands to convey what happened in a particular year. We typically release a report in January. This year, it was released in February owing to a fair bit of activity happening from a G20 perspective in the country. Now, before we go further, for all of you listeners on the call, just to call out what is the definition of a startup. This definition is slightly different from what DPIIT ends up following. For sake of the report, a startup is defined as a company which is focused on developing, deploying, and commercializing new products and services driven by technology or intellectual property. What this would mean is that we would only look at companies which are less than 10 years in terms of age. They need to have an India connection very, very strongly. That means the founders are Indian and significant amount of product development happens in India. It is very possible that some of these companies are headquartered in US or Singapore from a commercial perspective, from a financial perspective, but for all practical reasons, it's an Indian company. There's a strong element of innovation. What that would again mean is that if today somebody was trying to create another Amazon or another Flipkart, we would not consider it into this particular pool. So we are very, very specific in terms of saying that startups are building scalable solutions for newer problems. And not going after proven markets and proven models. And lastly, what we're looking at is a set of companies. None of these are idea companies. They have at least one product out there in the market. And what they are doing is they already are building product in conjunction with their customers. So it could be something as small as MVP, or it could be a revenue generating company. Now, the reason this definition is very, very important is it allows us to focus on a very particular subsegment of the Indian entrepreneurial ecosystem, which would also include small and medium businesses, which would also include, say, a shop or kirana stores that you have overall from an Indian entrepreneurial ecosystem. But our complete focus will be on scalable businesses, and within that, somebody leveraging tech very, very particularly. Right? Okay, so where do we stand today? Now, we have about 25,000 to 27,000 startups active in the country. About 5,500 of these have raised at least one round of funding. Close to $73 billion over the course of the last 10 years being invested in this firm. But if you look at the relationship between the status till date for these 10-year-old companies and 2022, you would notice that almost one-fourth of the funding came in a single year, right? And this is despite 2022 being a tough year. If you look at number of potential unicorns, almost one-third of the potential unicorns got added in 2022. Similarly, almost one-third to one-fourth of unicorns, active unicorns in the country got added last year. And this is where the story really sits, is that despite everything that we have heard in the market in terms of there being a funding winter, there being a drop in funding, which is all true. When you look more holistically, 2022 tells us very interesting things in terms of what really happened and what should we be really worried about and what should we not be really worried about. And that's what we're going to try and focus in the webinar today. Now, let's look at the numbers over the course of last 4 years. So first things first, 2019 was a very good year for the Indian ecosystem. We saw ramp up in investments from 2017 and 18. 2020 was an exception year because of COVID. For a good 6 months, investors did not know how to react. None of us did not know how to react. 2021 was again an exception year because there was a lot of exuberance for technology solutions. In the preceding 12, in the early 12 months, what we had seen was a huge focus on technology. We were doing everything online. And consequently, investors thought, hey, this is the world forward, and this is how the world is going to be forever. Take for example, education. Take for example, health and fitness. So there's a lot of exuberance, and consequently, this turned out to be again exception year because we saw funding reach all-time high in India and across the world. What happened in 2022 essentially was a correction, right? So you have a dip and you have an increase, and then you suddenly have a decrease. So what really happened? It was a correction. Consequently, what we have done for this particular year in terms of report is that the whole commentary sits in terms of comparing 2022 versus 2021, and also looking at a 4-year average funding to remove the exception years in between to build out a better narrative and story as to what really happened. And when you look from that particular perspective, few very interesting things come out, right? We had almost 1,600 deals happen, which was more than 2021. About 1,400 startups raised, at least one round of funding, which was again 18% higher than 2021. Almost 66% of this $18 billion went into non-unicorns. And we also saw upward, increase in the median ticket size for seed and early stage. So yes, there is a drop, but if you see a lot of other metrics tell us that there is something beyond the drop in funding that we need to focus on. When we do a double click in terms of where did the funding really drop, it becomes very, very clean and clear that the funding drop was essentially in the late stage of the business. Now, the biggest reason for this drop was that we saw a decrease in number of mega rounds. Mega rounds are rounds where a company has raised at least $100 million in a single shot from multiple investors. The decrease, the 41% drop in mega rounds would mean that, let's say, if we had 10 rounds in 2021, and now we only have 6, rounds coming in, 4 into 100, that's $400 million gone in a single shot, right? And that starts to give you a good sense as to why that drop is really happening. The second reason was that there was reduction in terms of the average or the median ticket size for late stage investments. And when you combine those two reasons, it's very, very clear as to what really happened in terms of the drop from $18 billion to $11 billion in terms of funding. Now, the question is, why did this really happen? The main reason for this change happening is, interestingly, not the startups or the asset class in consideration. It is actually the public market valuations, in North America and in India. For those of you who invest in technology stocks, you would remember that from 2020 to 2021, the technology stocks were increasing rapidly and on a non-stop basis. They were doing better from every perspective compared to any other industry in the world. Now, consequently, what happened was that a company which was generating $10 of revenue in 2021, would have required another 12 years to become a unicorn, right? So they would say, for example, require, at least 50 rupees into, say, 20 times multiple to become a unicorn. In 2021, the multiple became significantly higher. So now you require lesser revenue because the multiple was higher, and consequently, you became unicorn a lot more fast. And that is what really changed in 2022. The valuation multiples came down significantly, and suddenly it had an immediate impact on the late stage funding. Now, on the contrary, when you look at the early stage and the seed stage investments, what really happened here was that we continued to have a very strong momentum from 2021. The early stage investments were up. Similarly, the seed stage investments were up. We saw uptick also in terms of number of leads which were really happening in this particular period. Now, again, two reasons. The one big reasons we saw seed stage and early stage have an increase is because in 2020, 2021, these areas were very, very consistent. There was a larger pool of assets available for companies to investors to do a Series A, Series B round in. At the same time, the number of entrepreneurs and the startups had also increased over the years. So there was a very good pipeline for somebody to take a bet on. Simultaneously, from a valuation perspective, seed stage and early stage are typically a bit more far away from public markets. Consequently, they work on a different principle in terms of equity ownership and not necessarily multiples. And that had not really changed in 2021. So the rule book, which was applicable and had impact on the late stage investments and late stage valuations, was not as effective or not as relevant for seed stage and also for early stage. And that's why that gap really comes in. So on one side, you have a drop of 40% on late stage. On the other side, you have a growth of roughly about 20% on early and seed. And consequently, overall drop is roughly only about 21% at an ecosystem level. The best part is that all these metrics, if you see, are not only higher than 2021, they are also higher than the 4-year average, right? And this is something, if you see, we almost see that the 4-year average for late stage is again very, very similar to what funding we raised in 2022. Remember, we are talking about 2 exception years, and from a data analysis perspective, it is very important that we focus on the right reference points. Now, in terms of, where did this money really go? So we spoke of how 66% of all the investment went into non-unicorns. I think it's a very good sign because it gives you a view in terms of a pipeline getting created, more and more companies, growing and maturing, more and more options being there in terms of job creation, in terms of global leadership in different industries. On the same lines, roughly about 47% of the startups which raised money were raising their first round out of the 1,400, right? Again, a very good metric. I think what we will see in the coming years is this number stabilizing somewhere between 58 and 47. Our estimate is this should be about 50-51% in 2023 and going forward. It's a very consistent increase. It's still higher than 2022, higher than 2019. In terms of percentage share of startups who had raised their first round, but were also less than 2 years old, that again came to about 27%, right? So we are seeing that consistency between 2020. Numbers are still significantly higher than 2019. Now, why is this important? The percentage of startups raising the first round is important because it tells you how are investors participating in India? What can you expect as a pre-seed company or as an unfunded company? What are the odds of somebody taking a bet on you? This number being consistent also has an immediate impact on the unicorn numbers 3 years from now, 5 years from now. That pool should always keep expanding. The percentage share of companies which are raising the first round and less than 2 years old gives you some kind of a understanding as to have the Indian entrepreneurs learned to build companies in a better fashion or in a different fashion than previous years, right? So the premise is that as the ecosystem grows, as the knowledge base grows, people learn new skills and consequently they're able to pass the skill on to somebody else who then learns and is able to be a lot more effective for the same duration of time than their predecessors. Okay, so that's on the funding part. Now, the next question was that, okay, what really happened with IPOs, M&As and all? Now, IPOs, as we spoke about, it was not a great year from a stock market perspective, especially for tech. 2022 across the world, the biggest losers were tech companies. And it was not really any different from India also. And consequently, what we saw was that while we had a good, bunch of companies getting listed in 2021, in 2022, we saw fewer tech stocks getting listed, right? And what you have here is a very, not a great, but a very difficult storm of valuations changing, Indian investors maturing, typical private market valuations being higher than public market valuation, which usually leads to a drop after the listing. So a lot of factors really came into play. On the contrary, when you look at the mergers and acquisition, you would see that, it's been a fairly consistent market, right? So in 2021, we saw a very good uptick in terms of the M&A deals. The reason M&As and IPOs are important is because these are exit events. This is when investors are able to convert their paper returns into something substantial. The entrepreneurs also are able to create a new pool of capital for themselves. Similarly, employees also get an exit. It's very, very critical for the ecosystem's health. And I think what's really good for the Indian ecosystem is in 2022, the number of M&A deals continued to be similar, higher than 200 on the lines of 2021. So good momentum, it was continued. The difference, however, was that compared to the previous years, this year we saw the corporates being a lot more active, very specifically the Indian corporates. Our estimate is that in 2023 and beyond, we would see the global MNCs and Indian MNCs being a lot more active from an M&A perspective in India. There is still a crunch of talent. There is still a crunch of smart people in the industry, and acquisitions continue to hold good as a very good lever for somebody to expand their portfolio or build new technology capabilities. And when you analyze these deals, that's what you realize is that majority of these M&As happen from expanding the product portfolio or expanding the tech capability. So the underlying thesis in terms of talent availability and good talent availability holds very, very good. And consequently, we feel that M&A part will continue to stay strong in the coming year also. A common question that comes to us is from a sector's perspective. See that what sectors worked really well in the previous year, what did not work really well. So what we did is that we listed all the sectors and then we created a heat map. We added investment numbers for all the sectors for 2019, for the 4-year average, and for 2022. And what we really wanted to see here was that given that we had, exception years of 2020 and 2021, if we were to create 2019 as a baseline, we know that more funding came in, but was that lopsided into a particular sector? And in that sense, I think what's really good to see is that almost every sector has raised more funding than the 4-year average or than the 2019 highs that they had seen. The sectors which have not raised more funding, which would be, say, fitness and wellness, SCM logistics, mobility, these are typically sectors, or take, for example, automotive. These are sectors, if you see, were heavily impacted by COVID, and these are the ones which have been the last to recover in terms of the post-COVID recovery, right? For example, travel and hospitality started to hit its number only in the October to December period in terms of number of air travelers or the percentage of hotels booked and things like that, right? So there have been the sectors which recovered most, slowest, much later than the rest of the sectors. And that's reflected also in the fact that the investors did not want to put in more money to the time that the traction numbers went up. However, sectors like agriculture, if you see your utilities, social platforms, advertising, or enterprise tech or BFSI, these sectors continue to hold strong. These sectors continue to get a good share of investment compared to the 4-year average in 2019 also. And in that sense, we created a simple map to see that, okay, what was the relative ranking of a sector in 2019? So we put a rank from 1 to, I think, 20 for all the sectors in decreasing order of the funding raised. Similarly, in 2022, we looked at the decreasing order of funding raised to understand the ranking of a particular sector. And what you would see is that something like the BFSI or retail continues to be one of the top sectors in the country. At the same time, we have seen enterprise, education, social platforms, food tech, agriculture move up from a ranking perspective. And then we have, some of these sectors like SCM, real estate, mobility, travel, fitness, moving down in terms of the funding share that they have taken. Now, I think what I'm really curious about and very interested in is the fact that, we have sectors like aviation or life sciences, really coming up in the ecosystem. Or a lot of these nascent sectors, which are in the the lower order of 15 to 25 from a ranking perspective, also moving steadily upwards in terms of the kind of attention they are getting. It's always a good reflection of the ecosystem. The more diverse the ecosystem is, it's better for the country. It's a better reflection of India's story. It's a better reflection of our ecosystem. It's also a better hedge in terms of any sectoral movements or any sectoral impact that might come because of an unforeseen event in the ecosystem or in the world. The sectors that have been doing fairly good, which we call as the nascent sectors, because they're still not mainstream. Like, for example, BFSI, retail, food, enterprise. You would see so many stories on a daily basis. You would hear a story of a Freshwork or of a Ola or a phone pay. But when you look at areas like, take, for example, agriculture or say energy utilities or media entertainment, we don't get so many stories as often. And in that sense, if you see that the drop which happened in 2022 was very, very negligible. Compared to 2019, compared to 2022, there's such a significant jump in these sectors. A very good sign in terms of how technology adoption is now driving growth of multiple sectors in the country, how the consumer profile is changing, how the SMB or MSME profile is changing, and consequently the solutions that people are able to build and monetize in the ecosystem. In terms of areas, that seem to be coming up steadily in India, I think environment tech, anything to do with climate tech, aviation, maritime, defense, life sciences, these sectors saw a good uptake in terms of numbers. They are still very small in terms of the funding that they have raised, right? So we are talking about $100 to $200 million funding annually. But we believe that these are sectors that are very critical from India's longevity perspective. They are very essential for how we build our country and the kind of problems we are facing. If you look at the news stories the last 2 weeks, 4 weeks, we are seeing heat waves and cold waves happening across the country, which all of us are experiencing and consequently want to do something about. If you look at aviation, maritime defense is one of the sectors where we have very high imports. It's a big focus for the government also in terms of creating self-reliance. And if you look at life sciences, then again, this is an area that India has been known for. But now the question is that how do we move, further up the value chain, moving away from generics into newer drug discovery? Again, a huge population which requires healthcare and has unmet health needs. And that will always require a fundamental discovery or innovation to come in. Quite excited about these sectors. I think that these are still early. We have a long way to go. But these initial signs are very, very encouraging in terms of where we might be heading from an ecosystem and from a country perspective. Now, a lot of you are from academic institutions. I think it's important for us to note that about 12% of the startups are leveraging deep tech technologies. It's been very consistent over the years in terms of percentage share. Percent share is defined as number of unique startups leveraging deep tech divided by total number of startups. The good part is that while the percentage share is very, very, consistent, the growth rate is also consistent, growing at about 40%, in terms of the CAGR for the last decade. I think this will continue as more and more people get exposure to advanced technologies, as newer tools come into the market which improve the access to technology, and consequently we are able to rethink a lot of solutions and sort of leapfrog that we have traditionally done in India compared to other geographies. Now, the important part of the deep tech ecosystem was that typically deep tech startups have a longer gestation period compared to, say, a Swiggy or Ola. A deep tech startup would have a longer gestation period purely because the technology to build it requires a lot more time in terms of training the data. I'm oversimplifying it right now, but you need to collect the data, you need to clean the data, then you need to train it, and then you need to repeat that cycle to be able to see the solution really works. So by default, the gestation period is longer. The second was that because the gestation period was longer, a lot of early investors in India were not comfortable in terms of investing in these companies because they did not know how to measure, or they did not know how to even think about quality of an algorithm versus business metrics. Since 2020, we have seen a steady change in terms of how investors are opening up. They're taking a lot more risk, or they're trying to figure out how to invest in deep tech companies early on. And that's reflected right now in terms of the investments steadily increasing year on year. This is partly because the solutions are maturing, partly because investors are maturing. We believe that the deep tech ecosystem is at a stage where the Indian ecosystem was in 2015. In the next 5 to 6 years, there's a very good chance that we will compete head on with Israel in terms of the quality of solutions that we are building out from the country. Increase in the seed stage investments here and the growth stage investments is a very good number in terms of showing that those bets are being taken, funds are being made available, and options being there for people to expand. Now, let's come to the unicorn part. This is always something which gets a lot of attention in terms of conversations. When you look at the unicorn club, first, it's very important to understand that why did we have so many unicorns in 2021? This is the only single reason for this is the valuation, right? So let's say there was a company which had 10 rupees of revenue in 2020, and it had a multiple of 20, right? So what you're saying is 20 to 20, $400 million is the valuation of the startup. In 2021, the multiple, went almost 2x, 3x. So that 20x multiple became 40x multiple, 50x multiple. So if your revenue was still 20 rupees, because the multiple went up, suddenly you became a unicorn. And that was the single biggest reason why so many unicorns got created. Compared to 2022, when the market was sliding constantly, the valuations were dropping constantly, we nevertheless still added about 23 unicorns, albeit majority of them coming in the first 6 months of the year. We believe that this, in a sense, is also a good sign in terms of the correction of the market. Should these valuations have continued for another 1 year, they would have been extremely unsustainable and we would have seen a lot more worse impact in the ecosystem. And the correction of 2022 has calmed a lot of nerves, has brought back into the focus that the principles of building a good business have not really changed. They are not seasonal. Values don't shift. Valuations can shift, but the values don't really shift. So the core of business building is what you want to adhere to and what you want to really stick to. Now, all of that aside, a very good sign in 2022 of the Unicorn Club was that almost 74% of them, were B2B startup with almost 40% focusing on small and medium businesses. For the longest time, majority of our unicorns came from the B2C club. Almost 30% of these unicorns, the new unicorns are SaaS, and overall about 45% of the new unicorns are servicing global markets already. So very good pool, very heavy on B2B. I think for the first time, the B2B versus B2C split for unicorns is almost 1:1. It's a very, very good sign for the ecosystem. Of course, note that a lot of this can change, but I think directionally speaking and fundamentally speaking, the core is definitely getting a lot more stronger. Now, while unicorns, we spoke of another earlier metric, like how we spoke of late stage and early stage. Similarly, when you look at unicorns, we also look at the potential unicorns. Now, potential unicorns are defined as a set of companies which have raised at least some total of $50 million in a single round or multiple rounds, doesn't really matter. If you look at 2022, we actually added more potential unicorns than the previous year into the ecosystem. This is the real story. This gives us a sense that while some of the existing unicorns might lose their potential, their valuation, and come down, there is also a strong pool of companies whose valuation seems a lot more stronger and sustainable, who can move into the unicorn club, right? So we'll see some churn happening between unicorns and potential unicorns. But this pool of potential unicorns is very, very strong. It's the biggest we have seen so far. Again, B2C versus B2B split is very similar. So I think India has changed. It's become a lot more easier and viable to build a B2B business, which is technology first. Close to 70 of these companies have raised more than $100 million. This is the pool which has the highest also become a unicorn in, say, the next 12 to 24 months. So overall, a very, very good pool. We saw some, pieces coming in from maritime and defense also into the ecosystem. And we have also seen the fact that 40% of these unicorns are already, potential unicorns are already servicing global markets. Okay, so a lot of conversation on unicorns, on potential unicorns, IPOs, M&As, and investment. The next question usually comes in is that where is the money coming from? Are we seeing more investors participating in India? Because that is typically a very good reflection of who's looking to bet. It tells you, what kind of money is really available, what kind of options do people have, and bigger the better, because it creates optionality in terms of entrepreneurs finding the right partner who can not just give them money, but give them potentially additional resources, or quality money is there, right? Now, but obvious from the interaction, you see that, the mega rounds have dropped. So by default, there is a drop in terms of number of unique investors in terms participating in deals bigger than $100 million. But if you look at other pieces, which is say $1 million to $100 million, there's a very good uptake in terms of unique investors participating in India. The number of active VC firms has increased, the number of private equity firms has increased, the number of corporate investors has increased. So all in all, despite the year seeing a drop in total funding, despite there being a slowdown quarter on quarter on the funding part, the number of people looking to bet in India and looking for the valuations to stabilize before they start taking bets has increased, right? So it is safe to assume and safe to say that 2023, we should see a good amount of funding still coming into the country. And once things stabilize, it might again start to pick up a lot more in 2024 and onwards. This is what I would call as a leading metric in terms of understanding where the investments might go in terms of quantum and in terms of quality. From a corporate perspective, again, a fairly recent year, we saw a good uptake in terms of unique corporates active, almost 2x from, COVID times. Very good uptake in terms of investments, decent increase, as far as M&As are concerned, a consistent increase as far as open innovation is concerned. Again, overall, it can be said that the post-pandemic shift in terms of corporates looking at technology solutions and actively working the startup ecosystem continues to stay strong in terms of what we can expect from the ecosystem. Now, to do a very quick double click on a specific part from an investment piece, what we are really excited about is the fact that the majority of investments from corporates appears to be coming in seed stage and early stage. This is again very interesting because this is where you can unlock a lot of synergies and you can look at a new distribution channel by virtue of a corporate being invested in you. And it definitely changes how you build your business, how you build your startup. On the contrary, when you look at the acquisition part, you would see that majority of acquisitions are happening at late stage of companies which have been in the business for almost more than 5 years. This is again a very good time where the entrepreneur has a good idea of how the business will grow or not grow. There's also a lot of evidence in terms of getting a certain kind of valuation from the corporate, and that continues to be fairly consistent in terms of contributing to the major portion of the M&As happening in the ecosystem, right? Last but not the least, we have a fairly decent uptake happening from the open innovation programs. There's a lot of focus on commercial partnerships, joint ventures, license and vendor agreements in the ecosystem. More importantly, companies are creating structured programs to work with startups, which alludes to longevity of a particular capability. And also the fact that majority of these programs right now are being run by global MNCs, not Indian MNCs, for multiple reasons. But again, a decent year from that perspective in terms of consistency, in terms of participation, or in terms of action. Now, in terms of the final two parts from my side, I think, we try to reach out to a whole lot of founders to understand what they anticipate 2023 will be. Interestingly, majority of them were concerned more about hiring in this particular year in terms of getting the right people in the right quantity. It is not about layoffs, funnily enough. They were more concerned about investor sentiments because the belief is that the investors have the capital but are just unsure of whether to invest now or later. There's a lesser focus on market recession. There's a lesser concern from a valuation perspective. Our sense is that the reason this concern is lesser is because there's a lot of room for growth when you're a younger company. But investments and hiring become super critical for your operations and for your existence. And consequently, there's a lot of focus on business expansion by entering new geographies, entering new customer segments, or launching new products. There's a lot of intentionality about fundraising process. The startups are assuming that it will take longer than 2021 or 2022 to raise funding. And it's important to build relationships and to be very intentional as to how and when you raise money. And finally, there's a lot of optimism in terms of, increasing the team size or, expanding the revenue. A lesser known fact about the layoffs in India is that 20% of the companies, contribute 80% of the layoffs, right? I think we looked at the data and only 7 to 10 companies contributed to a couple of thousands of layoffs, while the rest of the ecosystem had also contributed much lesser than that, right? So don't look at just the media stories, look at the data and you see a very, very different narrative emerging in terms of what's happening in India. And on that account, the final piece, what we anticipate 2023 would look like is that there'll be a continued growth of B2B startups. There'll be a continued growth of deep tech and SaaS in the ecosystem. I think we should see the competition intensify as more and more investors and corporates become active in India and look to find that right startup to invest in, right entrepreneur to really back them up. Consequently, we should see investments to be at least similar to the 5-year average. And possibly higher. There'll be a slow ramp up. So I think what we will see is that by Q3, Q4, investments will be a lot higher than beginning of the year. Expect it not to be flat, but it will increase from Q1 into Q4. And similarly, we should see that expansion happening in unicorns, potential unicorns. On the exit side, our sense is that M&As will continue. IPOs should start coming into the market from Q3, Q4 perspective, because that's when the metrics will be better, the markets will be more ready. It'll be easier for a retail investor to figure out where to put money, where not to put money. So we are cautiously optimistic about the year. I think for all the horror of 2022, it was a good correction for the ecosystem. There's a lot of pain, no two doubts about it. But when you look from a fundamentals perspective, I think we are very, very strong, and we can anticipate India story to continue and for each of you to play a bigger role on the global landscape and global platform as we go forward. And yeah, with that, Jayashree, back to you.